Well, good afternoon, and great to see so many people here today to hear the Central and Eastern European story. As Damien mentioned, a lot of flow in 2017 is dispersing into the other markets, the so-called higher yielding markets, and Central and Eastern Europe certainly comes into that higher yield category compared with Western Europe. And here we have the record flows that have just exceeded 2007's 13 billion of flow into the CEE 6 countries. So that's the Visegrad 4 countries, which is Poland, Czech, Slovakia, Hungary, Romania, and Bulgaria. That's the CEE 6. So when I refer to CEE 6, that's what I'm talking about. And as I said, last year 13.1 billion euros came into the region. A very strong Q4 there, 5.5 billion of flow. So we're seeing that evidence of exactly what Damien has just said. In terms of where it's going, Poland actually had a bit of a hiatus first quarter last year, but in the second half came back very strongly. So made a great comeback, 5.1 billion of flow into Poland. The fastest growing was actually Bulgaria. Bulgaria's flows, 957 million, went up nearly 4 times, mainly into the retail sector. 2 or 3 of the largest shopping centres changed hands. South African buyers pushed up the volumes in Bulgaria. So Bulgaria was the fastest growing. Hungary grew as well at the margin. Also, Romania grew. Slovakia, Czechs, slight declines. In terms of the sectors, the strongest growing sectors were retail, up around 20%. Office flows actually shrank last year, but we think that may rebound in 2018 towards the record highs that we saw in 2016. We think office flows may be maybe up to 4.5 billion in 2018. But actually, what was very interesting is the hotel sector over doubled in volume. That is, to me, an indicator that the cycle is quite close to the top. When the hotel sector becomes alive, in general in stock markets, but also in real estate markets, that's an indicator that the cycle is starting to really heat up and become quite mature. So those are the developments on the sector and country front. In terms of origin, so looking at where the money has come from into this region, we first picked up a year ago that there were 3 new arenas, geographical arenas of money coming into Central and Eastern Europe. The first one was Asia, and Asian flow in 2017 was actually, in the red here, 11% of the overall flow. That's down from 2016's level, but still quite significant there. And the Asian money tends to be portfolio flow, tends to be actually almost corporate. They're looking for corporate platforms as well. When we're talking here, some of the world's biggest sovereign wealth funds from particularly Singapore, but also China. Then the second new source of money in 2016 was South Africa. So in 2017, actually 14% came from South Africa. South Africa is the biggest single country in terms of investment into the Central and Eastern European region. The real growth last year actually came from Central and Eastern Europe itself. So between the domestic flows of 18% there, the CEE 6 countries within themselves, and also cross-border, so Czech funds investing elsewhere, Slovak funds investing elsewhere, and so on. 7%. That's the fastest growth out of all these categories last year. We actually published a piece of research which we sent to clients yesterday, and looking at distributing to the press over the next day or two. That on the domestic investors in CEE being the driver and being the driver going forward as well. The domestic investors are very useful if you look at real estate markets around the world, particularly in Asia, where if you have a very large percentage of domestic investors investment, you are steadying the ship, you are creating domestic liquidity, you're creating stabilization, you get much less cyclicality, less volatility of flow if you have a large component of domestic investment. This has been missing historically from Eastern Europe because of the communist legacy, but gradually over time this percentage is increasing. We're now seeing it manifest very much in the flows in the region. As mentioned, there's a lot of detail in that piece of research we've just published. So those are the 3 new props. But elsewhere, in terms of the more traditional sources of flow, European flows still the largest single unit of flows, and then UK, USA also still reasonably significant reason. So it's pretty diversified in terms of where the money's coming from. But on a net basis, quite interesting statistics here. For the first time, we've actually looked at the net flow. So we're looking at the origin of purchases minus the origin of sales by global geographic region. And very interestingly, last 3 years, I'm showing the last 2 years, 2016, 2017, here the bars, the light blue and the dark blue bars, US big net sellers of commercial real estate in Central and Eastern Europe. Very interesting to me. Also UK funds and asset managers net sellers of real estate in commercial real estate in Central and Eastern Europe. European investors, net sellers in 2017. In 2016, CEE-based entities were net sellers, but a lot of that's the developers, particularly in Poland, selling to investors from elsewhere, particularly to Asian investors, particularly to South African investors. So you can see that Asian and South African funds basically net buyers. They're not selling anything yet; they've only just bought it. So very interesting trends here, and as I said in this research report, we looked at this in a lot more detail. So that's a new trend. That's a new information for you. In terms of yields, where are we? So as Damien mentioned, higher yields. So what do we have? We've had a very steadying of the compression of yields in Prague, in particular Warsaw. The yields did not compress in 2017. Where they did compress was in Budapest. So what I call the Orbán discount. So the fact that between 2011, 2013, 14, the Hungarian investment market was very, very weak, very, very low volumes. What we're now seeing is that the world is used to the Fidesz government in Hungary. Maybe is comparing it to some other governments around the world and saying, well, actually, Mr. Orbán doesn't look too bad compared to them. So we understand the situation in Hungary now. So therefore, Hungary's yields were just too high compared to Budapest's yields were too high compared to Warsaw and Prague. So those yields came in 2016 by 50 basis points each in office and industrial, 25 basis points in retail. Where else did we compress? Bucharest industrial 50 basis points. Bratislava again industrial 50 basis points compression. The industrial sector was pretty hot in terms of yield compression, and then Bulgaria as well, which is obviously the highest yielding of these six markets. Big compression across the board in Bulgaria, in Sofia, particularly in the retail sector, where, as I said, there's three big shopping centre transactions last year. Now, what's going to happen in the future? I published this chart a year ago in my 2017 outlook and said that we would have larger flows. What we've got here is the light blue line is the Eurostat Composite Consumer Confidence Index for the CE6 countries. So I blended them together equally, weighted them equally, drew this blue line, and then I pushed it out in time. So these data points have actually happened. I've just pushed them out 18 months. And we've got here the investment flows into the region on a 6-monthly basis. You can see it's pointing that we should see slightly higher flows on an absolute basis in 2018 and maybe into 2019. Now, I'm not promising this, but as I said, I published it 12 months ago and it came true. So we'll see how it goes again in the next 12 months. If this light blue line starts to turn down dramatically, don't worry, I'll tell you, because that will maybe indicating that the flows will start decreasing in the future. But at the moment, it looks like we could have an extra 1 to 2 billion of flow in 2018-19. Why? As I've written at the top here, we've got an escalation in GDP growth in the Central and Eastern European region. I mean, Romania shot the lights out in the third quarter with nearly 9% year-on-year economic growth, 7% in the fourth quarter. All of these countries, the growth is accelerating, and maybe some of these economies, particularly Romania, are overheating, and therefore we may see interest rate rises as a consequence of this. But in terms of fundamentals, in terms of the ability for rents to increase, this is positive news for all the sectors, all the major commercial real estate sectors, particularly retail, because obviously people have money in their pockets as a result of higher economic growth, but also logistics, and manufacturers in the region have exposure to Germany. Germany is the locomotive of the CE6 countries. and German demand is very, very strong. So the exports that we're seeing from these economies are very, very strong. So these factors are all feeding into very fast economic growth. I expect these figures to sustain in these ranges in 2018. What we do see, and we outlined in our 2018 outlook, is actually the development boom is unfolding now in the region. On this chart, I've plotted overall sentiment in the Central and Eastern European 6 countries. Again, blended the 6 countries together, the light blue line, and there's a sub-index, the construction sentiment. Now, the construction sentiment, you can see, is more violent. It moves more in a more volatile way than the overall sentiment in these markets, and it lags slightly in time. And I think what happens in the boom phase is that the constructors get very, very excited towards the top end of the cycle. They build too much, there's oversupply, and we fall over the cliff. And that's what happened in 2008, 2009. We bottom, and the developers are very, very depressed. The world's ending, and therefore the sentiment takes a long time to pick up. But now, where are we again in terms of sentiment? We are accelerating towards a peak. So this is another indication that maybe over the next 18 months we are moving towards the top of the cycle. Very briefly, wage pressures are a feature and a positive for rental growth. If we look on this chart, we've got wage growth. So these are our expectations for wage growth in Poland, 8% this year. Czech Republic, 8% this year, following 7% last year. I've matched this against the CPI, the latest year-on-year readings for inflation. This means that money in the pockets of Poles, Czechs, Hungarians is real. They're getting, in Hungary, 10% wage increase versus 2% increase in prices in the shops. So these people, inhabitants of these countries are feeling richer. They go out, and a lot of them go out and spend that money, particularly at the lower end of the economic scale. So this is driving these economies, and is very, as I said, very much an underpinning of rental growth in 2018. But it's inflationary. What it leads to, the CPI, the same CPI readings in dark blue, it leads likely to higher bond yields and therefore higher interest rates over time. We've already seen 3 interest rate hikes in the Czech Republic, and the Czech Republic was the very first country in Europe to start raising interest rates last August. We've seen rate hikes in Romania as well. Now, obviously, some of the countries are linked or actually in the euro, for example, Slovakia. So eventually, in Germany, we've got 1.6% CPI and 0.63% 10-year bond yields. I expect that German 10-year bond yield to rise. And something we covered this morning by Walter Botcher and Damien in their presentation. We expect those yields over time to rise as the ECB removes its stimulus. So this is going to drive bond yields up. This is going to drive funding rates up, and this is another factor which might end the cycle in Central and Eastern Europe in a year or two's time. Risk. The other risk maybe is a political one locally. Now, in Central and Eastern Europe, we have a real mixed bag of government situations. In Slovakia, things were looking pretty steady until the very, very unfortunate murder of the journalist a few weeks ago. So maybe Mr. Fico's position in Slovakia may be weakening. He's under a lot of pressure at the moment. Connected with that is obviously a lot of allegations of corruption in Slovakia that may be surfacing. In the Czech Republic, we haven't had a government since October. Now the economy is doing very well, so it hasn't mattered yet, but we still have no government in the Czech Republic. In Romania, the new Prime Minister, she's been in power for only 2 months, and she's the 4th Prime Minister in Romania in the last 2 years. Very short-lived at the moment, so very no track record yet of stability there in Romania. In Bulgaria, we have a populist-leaning government. Mr. Borisov has taken the political scene more towards the populist side, and obviously in Poland, certainly internationally, the perception of the Polish government is populist, perception of the government in Hungary is also populist. So real mixed bag of governments. This is some risk in terms of investment that we need to think about going forward. And then, so very briefly to conclude, on the economic side, very strong economic growth, firming rents, wage growth, very positive for the retail sector in particular. We've got this development boom happening, which has all sorts of consequences, and I'm sure the panel will be able to give you some colour on that. Inflation spike actually helps rents. This Eurozone CPI is the benchmark for rents in this region, so if we have higher inflation in Europe, that helps the rental growth outlook. And the effect of those rate rises, in my view, is not immediate. That we've got very large, what I call funding cushions. This is something I've analysed in my reports. Very large funding cushions between the funding rates and the yields that we've got on the commercial real estate. So your effective IRRs are quite wide at this point. On the negative side, the rates are rising. The interest rates are rising, and therefore we have to worry about these things in the longer term. E-commerce is certainly a risk for retail, as it is in other sectors, obviously, and more of an opportunity for logistics. Wage growth negative for the BPO, SSE and industrial sectors if we have a very tight labour markets in the region. No government, as mentioned, politics, EU funding issues with the Polish and Hungarian governments arguing with Brussels all the time. That might come into the play in the next 2 years. And then a couple of global issues, trade war risk. I mean, obviously, Trump and China is happening globally. Taxation risk. There's always a chance that governments actually may start to tax assets rather than labour. So that's maybe a longer term risk for all real estate holders. But certainly in Central and Eastern Europe, with some of those more populist governments, might come into play. And we've seen some echoes of that already in Poland, for example.